Hi, Larissa here, founder of Short Rental Academy. I'm just going to be, Michelle Maynard is going to be joining me today from the Carbon Group, and she will be talking about tax. So I have a lot of people ask me tax questions when they're looking at doing short-term rental, when they're already running a short-term rental. They just want to know a few of the tax questions, and they're always changing. So we're just going to go through a few of these tax questions today. And thanks so much, Michelle, for joining us today.
Thank you for having me today.
So I just wanted to go through a few questions I get asked a lot especially for owners who are wanting to set up a short-term accommodation, a rental solely for short-term rental. So a lot of them would want to know, do they have to register for GST as an owner of just, say, one apartment?
Sure. So the answer is usually no. So the renting of residential premises is GST exempt. So people who have a short-term rental or an investment property that is residential in nature don't register for GST, which means they can't charge GST to their tenants, and they also can't claim GST back on any of their expenses.
Okay. And is that the same if they've got one apartment or even 10 apartments?
Yeah, so it is, and I caveat that by saying there is a rule which talks about if you have a commercial residential property, but a commercial residential property is basically if you own a hotel. So, if you own the building with all of the rooms and its sole purpose is that if you have 10 separate different rental properties that you use for short-term rental, it's still residential accommodation, which is GST free.
Okay, great. And do they pay tax on their rental fees?
Yeah, so this is a different horses for courses type answer. Yeah. So if the income that you make from your rental exceeds the expenses, then the entity that owns the house will pay tax on any profit from the rental venture. So if a husband and wife own the property together, any profit is split 50-50 and then they're assessed in their own names.
Okay. Excellent. And what sort of deductions do you think they can claim for?
Yeah, so basically anything in relation to the rental property. So council rates, water rates, any of those holding type costs, any repairs and maintenance. Now that's a big one. So it has to be repairing the property to the standard that it was before, not improving it, because then that would fall under depreciation and it comes under a different category. So if something breaks, the carpet is ruined and you replace it with light carpet, then that's a repair. If the carpet is faded and then you rip all the carpet out and put down hardwood floors, that's a capital improvement. So we just need to make sure that we repair things so we can claim the deduction up front. Any sort of leasing expenses, so if the property is managed, any advertising fees, inspection fees, property reports, those types of fees are deductible. Insurance is a big one. In these types of scenarios, you need to make sure you have insurance, and that's deductible. Interest and borrowing costs. So most people don't buy these things outright. They have a debt against it. And then anything that's purchased to use in the property. So I'm talking about things like linen, cutlery, crockery, TVs, anything that you use to be able to provide the rental accommodation, that's all deductible.
Yeah.
What I will have.
Yeah, so that also includes toilet paper, things like that. Yeah.
Yeah, cleaning expenses that you buy to use to leave there, the cleaning of the apartment afterwards if you use a service. The ATO has introduced a rule at the beginning of last year to say that travel to and from your rental property is no longer deductible.
Okay.
So people can claim their kilometres, so you can't claim that now unless it's rented out and managed by a property manager.
Okay.
In regards to any deductions that you claim into your rental property, if there has been any private use of that property, you need to apportion it. So if you stayed there for a weekend, or if you let family or friends stay there for a weekend at a reduced rate, you have to take out that portion. It has to be solely rented to third people or available to rent to third parties at all times to be able to claim 100% of the deductions.
Okay, great. I didn't know that. I know last year we were claiming for the travel, but I didn't know this year we're not going to be able to claim for that.
Yeah, it's a new one. And the other thing that they've changed too is what we normally tell our clients is if you buy an established home, go and get a depreciation report done because you can claim the depreciation on the capital works, which is the actual building. and the building costs, and then the property and plant fixtures and fittings within there. And it used to be that you could claim the fittings and fixtures and the property improvements, even if you hadn't paid for them.
Okay.
But the ATO changed that, so they've restricted the rules. So basically, you still get what we call the capital works deduction, which is the cost of the building and the depreciation of that. But unless you paid for the fittings and fixtures or the property improvements inside the house, you no longer get to claim that depreciation. You do if you pay for it subsequent to purchasing it, but you no longer get the benefit of someone else's work and money spent as you did previously.
Right. Okay. Okay. So also one of the questions I get asked is for online travel agents based in Australia. So they charge us GST, is that right? Do you know much about that?
Yeah, so travel agents and GST is a hard one because they're dealing not only internally but externally. So my understanding is if the taxation is based in Australia and the travel relates to Australia and solely within Australia, then yes, GST is charged. If Australia is a starting point or an ending point to sort of go out of the country, then GST isn't. It's a very grey area, but majority of the travel does relate to Australian premises, Australian-based holidays to Australian with an Australian travel agent. Yes, it will include GST.
Yes, and what about overseas? Do you know much about? I mean, they've got a VAT.
Yeah, so that is a value-added tax. So different countries have different versions of the GST. But yeah, at the end of the day, whether there is a GST or a VAT on it, it doesn't really affect you unless you can claim it.
Right.
And in terms of, it would just be the whole cost. Otherwise, you don't get any deductions if you don't relate to GST.
Okay. And if you're selling your vacation rental home, what fees apply? Or is it the same as any rental investment property?
Yeah, so basically in terms of, are you talking about like selling costs? Or, so if it's a residential property, or are you talking about the tax consequences of selling it?
Tax consequences, yes.
Tax consequences, sure. So, yep, so the sale of a rental property, whether it is vacation or normal day-to-day rental, is still the same. It's still capital gains tax. So you will pay to the owners, and depending on their proportions of it, the husband and wife, it would be 50-50 each. They would pay capital gains tax on any gain over the sale price. So you take the sale price less the purchase price, and then you need to add different things back. So if you've claimed capital works over the life of the property, you need to add that back, so that'll increase your gain. However, if you've had some holding costs that you didn't claim as a deduction, such as rates, land tax, which you normally can claim, but if there was a period that you didn't, you can add those. But there will be a capital gain on that property if it's sold at a profit.
Yes.
If you've held the property for longer than 12 months, then you get a 50% discount on that, to the 50% of the gain is disregarded, and you will only pay tax on the other 50%.
Okay, excellent. And for record keeping and documentation, do you need to keep all your paper receipts? What's the best way to keep your records? Yeah,
you definitely need to keep all your receipts. The ATO is cracking down on deductions at the moment. They've plugged a lot of money into setting up task force. So, and when I say keep your receipts, it doesn't need to be a paper copy. What I advocate to all of my clients is take a photo of them and store them somewhere on the cloud. Because we know receipts get lost, they fade, never find them. So if you take a photo, if you have like somewhere, it doesn't have to be on the cloud, but it can be on your computer. If you have a folder for all rental property related items, take a photo of that, store it there, and then your accountant will have all the information they need at the end of the year to make sure you maximise your deductions.
Great, that's a great idea, because even if you're shopping, you can quickly take a photo, and you've got the little, the iPhone, you've got the love heart, so you can save it into different files. So that's a quick way just to do it every time you get a receipt, and you've got it saved in the cloud.
And it saves, around this time of year, June, everybody sort of starts going back through all their bank statements and then tries to find receipts. At least it'll all be there, because there is no law that says you have to have a paper copy. It just says you have to have a copy of it. So with technology, this is the best way that we can make sure that we get to claim everything that we need.
Sure. I mean, can you go off your visa statement, or is that so you've got to?
No, you actually need a copy. You actually need a copy of the invoice. So yeah, you definitely do.
Yeah. Okay. And can So can you also claim against your home loan if it comes at a loss? So if you're sort of not covering your your mortgage payments, that's obviously coming at a loss.
Yep. So basically, it depends on the entity that owns the property. So if we're just talking about a mum and dad that's bought a rental property, if the interest is more, if all the expenses totaled are more than what the income is from the rental property, then yes, you can claim that loss in your tax return and it will offset other income. If you have the investment property in a different structure, such as a company or a trust, things get a little bit more difficult. But if we're just talking about mums and dads, yes, if it runs at a loss, you do get the benefit of claiming that against other income in your return. If you don't have any other income, you just carry that forward loss until such time that you do.
Okay, great. And what happens when the rental payment expenses exceed the rental income? I think that's
so basically.
Question, yeah.
Yeah, so it's basically the same thing. So it's what we call negative gearing, and you would have heard that term bounced around in the media because Bill Shorten and Labor are currently talking about stopping negative gearing and not allowing it. So at the moment, as the law stands currently, if you have income on your rental property and then all the deductions exceed that, it's a loss, and that loss is claimed in your tax return. And if you have, say, employment income, you would get a refund because it reduces your taxable income. So at the moment, as we talk today, that law still stands. You are still able to do it, but there is talking around stopping negative gearing and not being able to claim those losses. But that's still up in the air. We're not sure what's going to happen with that yet. I think the important thing is, especially with short-term rentals, it's not like a normal residential property where someone is normally in there all the time. There is the ability to have it vacant for a while and therefore have the temptation to let family or friends stay, or to go and use it yourself if it's sort of down south or somewhere that you would normally visit on a holiday. The important thing to know about that is any private use or even discounted use. So if you rented the short-term rental out for $250 a night, if you rented that to somebody you knew for $100 a night, you have to apportion your expenses. You can't claim all of them, and the ATO is cracking down on that. So definitely make sure that you keep track of who uses the rental, when they use it, and how the booking came. Because if it's third party through sort of some sort of legitimate booking site or your normal processes, then you can justify claiming all of the expenses. If it's a family or friend member, you are going to fall into that grey territory. So definitely make sure that you keep those records and speak to your accountant about the best way to claim things, because while these are overall general tips, each individual situation is differently and what you can claim is different. So it's best to get that professional advice.
Yes, great. Thanks, Michelle, for speaking to us today. That was fantastic. That's great to get that information. That's going to be really helpful. So thanks very much. Thank you so much for joining us today. I hope you really got something out of that. And Michelle was really helpful. Thanks so much, Michelle. I'm going to pop a link down below to Michelle's direct web page. So if you jump on that, if you want any more tax advice, and also if you liked, please press like. And I'll also pop a link to our blog site and to our Facebook group for short-term rentals. So if you're interested in a short-term rental or you're running a short-term rental, you might want to jump onto the Facebook group.